Hello, my name is David Stevenson.
And my name is Paul Quattrocasas.
And together we're the founders of Future Food Finance. This is the third of our podcasts where we aim to talk for about 15 minutes about some of the really interesting stuff that's going on in food tech, identify kind of the key news stories that are out there, and also do a bit of a deep dive into a subject that fascinates both of us. We're going to talk on the deep dive about food delivery, a sector that, at least in the public stock markets, has had a bit of a tough time in the last couple of months. But first, we thought we'd just touch on a couple of stories. And I sort of pull out three stories that I think are really interesting. The first is that Nestle have just announced some results, and it showed that their plant-based proteins and their alternative foods segment of the business has grown rapidly. And I think that reinforces a key insight a lot of people need to get their heads around, which is everybody thinks it's all about startups in the kind of alternative protein space. It isn't. The big food guys are very present in this market. They're buying up businesses. They've got their own businesses and brands that are operating in this space. And Nestle is probably one of the key players. So a classic example is that in Nestle's business, when their brands include Garden Gourmet, Natural Bliss, Vuna, and Sweet Earth, that category had already reached $860 million in sales in their most recent numbers. So these are meaningful numbers in the alternative protein sector. So when you think about alternative proteins, don't just think startups. Think about the major guys. And Nestle's big in that, so is JBS. So are all the big food companies, really. The second story which has emerged, which I think is really interesting, is that there's a Series A for a Singaporean outfit announced, which raised $100 million. And we've talked a bit about this before. But that's a huge sum for a Series A. So you usually go Series A, Series B, Series C, D, and E, and seed before that. And $100 million for a Singaporean food tech startup is a lot of money, even in these markets. And that does show you the disconnect that's still going on between the world of venture capital, which has its own dynamic, and the public markets, which have their own dynamic, which is mostly depressing and bearish at the moment, particularly after events in Ukraine. And these two markets could disconnect for quite some time, and in fact could disconnect over even a couple of years. So the private venture market is still going strong and going like gangbusters. And that series, $100 million Series A, I think is an indicator of it. And then the last thing, we like to identify key trends here. The key trend that I would watch out for is carbon sequestration. I think there's already been, I remember reading a couple of weeks ago, there's a story in Australia about Australian farmers, traditional farmers, kicking back, or landowners kicking back on an Australian scheme, which is effectively using carbon sequestration via reforestation. And they were saying this is outrageous, it shouldn't be happening. I think there was another scheme in Wales as well, where some landowner, I think it may even be Foresight, one of the big infrastructure companies, has bought a valley in Wales that's looking to reforest it by sequestering carbon in trees. And this is all getting a bit of a kickback. And the reason it's getting a kickback from traditional farmers is because it's growing fast. There's a real interest in carbon sequestration out there, and there's a load of very interesting startups being launched. Sifted, one of the startup news websites, part owned by the FT, did a very interesting article only a couple of weeks ago about a startup in the carbon sequestration space. And the reason it matters is because as carbon prices increase, which they are likely to do pretty inexorably in my view, then carbon sequestration actually begins to make sense. It begins to make sense for landowners to convert their land to be able to sequester carbon. Lots of issues around measurement, lots of issues around how you actually know whether or not the carbon is being sequestered. But this is a very, very big story. Anyway, so those are some of the favorite stories. We'll go do a bit of a deep dive. And Paul, I'm going to bring you back in at this point. Food delivery.
And David, just before that, if I can interrupt before the food delivery, I just want to comment on the first two stories or things that you mentioned. The first one about large companies, you mentioned Nestle. I agree with you. And I would also point out that yesterday, another large food corporate, Givaudan, Swiss-based flavors and ingredients company, announced a new technology, integrated technology they call PrimeLock Plus. That integrates the flavor and fat. They encapsulate and protect the flavor and fat within plant-based meat substitutes. This is an especially interesting area because a lot of the complaints that consumers have about plant-based meat and plant-based food is that it doesn't taste very good. Doesn't taste good. And there's so much interesting activity going on at the moment among both private companies like Motif Foods, as well as the larger corporates like Nestle and Givaudan, to solve that problem. Again, it's the promise of technology in food. I just wanted to comment on that investors should be aware of, that larger corporates who are innovative, have the right mindset about this space, are certainly worth.
And Paul, I pick up just something you just said there. I absolutely echo. I think that idea of using fats and oils and other additives to make plant-based food or even cultured meat more like traditional meat, I think that's a huge kind of sub-niche sector on its own. Sorry, interrupted.
Yeah. And then the second thing you mentioned about the Singapore 100 million Series A, this is fascinating given the current market conditions, and there is still a gap between public markets and private markets. Private markets are continuing apace. That gap tends to close over time, but at the moment, private equity, venture financing is extremely strong still. And I would point out that just a few days ago, wild type, which is cultivated salmon or lab cultured fish, in this case, focus on salmon, raised $100 million Series B at a $400 million valuation, $450 million valuation, I think it was. And I find that especially interesting because we were just talking, I think a few weeks ago, or maybe before that, about Blue Nalu, which is another cultured fish company, but they're focusing on the other extreme, bluefin tuna. So we have bluefin tuna at the highest price end and salmon at almost the lowest price end. And you'll have Blue Nalu saying, well, we don't believe yet, or we're not convinced that salmon can be economic. And then you've got Wild Type saying, well, salmon is among the largest fish markets in the world, and we think it can be economic. And I just think that's a reminder of the variety, the breadth and the depth of companies that are forming and addressing all different markets, despite different opinions. They are still attracting capital. So I just wanted to point out that I agree with you that it's an extremely interesting space continuing even today.
Yeah, and actually, we've just gone through two of my favorite subsectors really, which is kind of additives and fats for food, which I think is really interesting. And I think that actually, if you're looking at cultured meat, then I think absolutely fish is where it's at, because I think the price dynamics on fish, it is at the lower end of the fish value added chain, so to speak, about what people spend on money. But it's still people spend a lot more money on fish than they do on, say, minced lamb or minced beef. Yeah. So therefore, it's much more of a niche market where cultured meats can really penetrate. Anyway, we're going to talk a bit about food delivery. Again, I was saying, Paul, it's had a bit of a tough time on the public markets. The big guys have really had a tough time, Delivery Hero and all those big companies. What's your take on what's happening more generally within the food delivery market?
Well, food delivery fundamentally is growing. Fundamentally, orders that human beings are placing to have restaurant food or grocery delivered to their home is growing. You wouldn't know that or think that if you just looked at the share prices of these companies over the last 6 months, year, 2 years, because they have declined dramatically. So if we just look at the bigger ones, Just Eat, Deliveroo, and Delivery Hero, their share prices are down about 60% in the last year. And many of them are below their IPO price. They're below where they were during the pandemic, which is interesting because they are larger companies in terms of orders and revenue and gross profit than before the pandemic. So why is this? Don't want to comment too much on the public market pricing, apart from saying that in general, we're finding that as relative demand has declined as we come out of the pandemic and people are not needing to order food from their home in the same way that they did during the pandemic, adding to that the rise in interest rates, the concerns in public markets that we're seeing, there's no surprise that the share prices have declined from their peak. In fact, if you look at a company like Zoom, and I think we've touched on this before, Zoom, which is the poster child of the pandemic, video conferencing company, its share price is back to where it was before the pandemic, despite being many multiples the size of where the company was before the pandemic in terms of revenue and gross profit and number of users. So one way of looking at that is that, well, maybe prices have come back to earth, and it may be a good time to invest in these food delivery, grocery delivery companies. In fact, there aren't really that I can think of any pure grocery delivery companies today that are pure plays or standalone in the public markets. There are many of them in the private markets. Getir and Gorillas, GoPuff are a few of them. GoPuff is talking about an IPO, and last time I looked into this, it was around the $40 billion mark. So that is something to keep an eye on in terms of the grocery delivery companies. But the theme is, how many of these companies will survive? They've been raising, as we talked about, hundreds of millions of dollars over the last 12 to 24 months, and they are all losing money. The food delivery companies are still losing money. These are the Deliveroos and the Just Eat takeaways. They're still losing money. And so why would they be valued at 2 times revenue, for example, or 3 to 10 times gross profit if they're still losing money? Well, there's promise, just in the same way that Amazon had promise for many, many years when it was losing money. But also people forget, in the case of Amazon, that it wasn't just the retailer that drove the let's call it profits to be of Amazon. It was AWS, the cloud hosting business that was very profitable, that drove Amazon until the retail business of Amazon became profitable on its own. The promise of scaling like that is one of the reasons why Uber was able to sustain the high valuations in the early days, which only, by the way, recently, Q4 2021, turned a profit. So Uber only turned its first profit last quarter. And that is one of the reasons why these food delivery companies still have high valuations relative to their revenue and gross profit, because of the promise that they will scale, continue to grow in the same way that Amazon did, that Uber did. Now, is that going to happen with all of the food delivery and grocery delivery companies? Let's just say there will probably be consolidation. So there will be winners and losers. What the landscape's going to look like a year from now is anyone's guess or opinion. But David, I think that's, from my perspective, the summary of the landscape of food delivery and grocery.
I was going to ask you, Paul, what do you reckon? Because one of the more interesting stories is about kind of dark kitchens, and I suppose you could call them dark black boxes, really, i.e. kind of local logistics hubs, which is, I think, a dominant thing within some of the local food delivery companies. These dark kitchens, which provide the food, and the kind of black boxes that provide the food that gets delivered, they've also started grabbing attention. A lot of money's gone into the dark kitchens, and there's been a lot of pushback from, for instance, local authorities a lot of local councils have started pushing back and saying, whoa, we didn't realize this was going to be so much traffic going in and out of these dark kitchens and dark black boxes. Is the dark concept, the dark black box, the dark kitchen, is that central? Do they need these kind of more localized hubs to operate out of to provide?
No, that's a good question, David. I think the theme is more automation rather than dark or ghost. So with restaurant delivery, food delivery, you get ghost kitchens and dark kitchens.
Yeah.
With grocery delivery, you get dark stores where a Getir or Gorillas or GoPuff or Jiffy, Zap, so many of these companies are building stores, but they're not available to the public yet.
Yeah.
Some of them are hybrid. DoorDash is doing it in the US, but they are dark. They're only available to the company, to Gorillas or Getir or GoPuff that wants to deliver to its own customers. Yes, there are complaints about some of these stores because you get drivers coming in and out. Ghost kitchens, you may get a similar complaint if you've got a very busy kitchen and you've got drivers coming in and out. Is that a big deal? No, I don't think it is. I think well-managed companies resolve these problems fairly quickly. They get around the issues, whether it's regulatory, licensing, noise. For a company that is performing well, that knows what it's doing, it makes a course correction, makes an adjustment. What I think is much more interesting and less of a temporary blip but more fundamental to the economics of these companies, which is what it's all about when it comes to investing, is the company's ability to automate their entire value chain, to automate everything from how they source the food, whether they are a restaurant and they're doing ghost kitchens, for example, or whether they are a grocery delivery company delivering groceries. To what extent can they automate the sourcing of the food or creation of the food to actually dropping it off at the customer's door? And I think the thing that we really should all be looking at and thinking about, although it's still a little bit early, is drone delivery. So we've talked about robot delivery, Starship robots and the like, which is also interesting. And there are many companies, delivery companies, that are using those robots, as well as automated vans, automated vehicles. But drones is where it gets very interesting, because you may have some noise of drones, and that's one of the things that drone companies are trying to solve is the noise of the drone so that it's quiet. But you are producing less, or emitting less carbon into the atmosphere when you have an electric drone. You're not using as much fuel or electricity, presumably. You are getting to the destination much more rapidly. Instead of say half an hour to a relatively rural area, you're doing it in 5 minutes. Drones are not going to necessarily help the 15-minute instant grocery delivery within a metropolitan area, or a very, very quick ghost delivery of restaurant food within an urban area. But it is going to dramatically impact the urban deliveries. And you also have much less congestion on the road when you start having these kind of deliveries. So why do I mention that now? Because if you are a genuine long-term investor, and you'll hear me comment on this frequently, whether, what is your time frame? Investing, trading, it's all about time frame. If you are trading in and out of a portfolio, if you're trading, on an hourly or weekly or monthly basis, then this isn't so relevant. But if you are investing, if you're taking a view on a company, on a management team, on its ability to execute on a strategy, to deliver the economics that they promote to the market or their stakeholders that they're going to deliver, and you're taking a long-term view, then start to identify which of these delivery companies are more likely to automate their entire value chain, to use technology across their value chain, including, if they're on the delivery end, using drones when those drones do get approved for use in certain jurisdictions, using drones to be able to make those deliveries. Because I think that's where things get very interesting. In a similar way, Uber management talked during the IPO to investors about automated vehicles. And the day will come when Uber will no longer have to hire human beings as employees to drive the cars. And when that happens in Uber's mind, Uber is truly an asset-light software company, because it literally is designing and deploying software to manipulate an asset, which is a vehicle, to go from one place to another place and not having to do anything else. It doesn't own the asset, doesn't own the vehicle, doesn't have to employ human beings to do any of the stuff that delivers the value to the customer. And I would say, and again, that's quite a far way out, 3, 4, 5, 6 years. When it comes to delivery, however, and we're talking drones, it's much less demanding for regulators and for those who have to approve a drone than approving a self-driving vehicle. So that's just a thought I'd leave people with.
And just one last quick question. You're saying that about automation. Do you think it's realistic that they could eventually automate food production, a restaurant, the dark kitchen? Do you think that's
already happening? Already happening. So you get Flippy robots, Miso Robotics, a lot of robotic companies that are designing and improving at a quite rapid rate robots to flip hamburgers, to make the burgers entirely. There's a company called Creator, which is a restaurant, which is completely automated. There are several pizza companies today that are completely 100% automated pizza restaurants, from the production to the delivery. So yes is the answer. That is coming even faster than drone delivery, is the actual production, the automation, robotic production automation of the food itself.
Right. Okay. Well, on that fascinating point, that's it for this week. If you want to find out more about any of our views on what's happening in the food tech space, do take a look at futurefoodfinance.com. Take a look at our index, which tracks some of the most heavily traded, publicly listed companies in the food tech space. And we'll catch up with you again in 2 weeks' time. Bye-bye.
Bye-bye.